for more of a truth and reconciliation discussion and more of a realization.
What is going on, guys? What is going on? Wait, it's 12:30. No, it's 1:30. It's 1:30 p.m. Eastern time. What is going on, guys? Been waiting all day for this moment. Wow, I feel honored. Thank you. Prolific, Eric Benitez, Silver Baker, Fernando Partida, Surf Dragon, Swift Snail. What's going on? Same plays at 2:30ish and again at 2:45. What does that mean, sir? Start a Q&A. Answer viewer questions live. Oh, what? Wait, what does this mean? Hold on. Ask me anything. Does this work? I've never done this before. What is this? I don't know. Let's try this. If not, we will end the Q&A. How's your day? I'm not going to answer this, bro. Come on. Hard shell or soft shell tacos? Okay, I see you guys don't want to answer me. You guys don't want to ask nothing about the markets. All right, let's get right into it. So what today, hold on, that's not the right one. There it is. All right, so the market, obviously, yeah, it's working. Duarte Machado is working. The market obviously is waiting for the FOMC statement, right? Now, we all know that the Fed is going to skip, especially since we've had data point after data point come in stronger than expected, right? Whether we're talking about inflation or unemployment, there's no way that the Fed can cut here. Now, I've told you time and time again that the Fed only cuts when something goes haywire. And if you look at historically, I don't know if I actually... Okay, yeah, this is what I was looking for. If you look at historically when the Fed cuts, right, because I get this question all the time. And by the way, Jerome Powell is going to speak at... We're going to get the FOMC statement at 2, which is in 27 minutes. And then Jerome Powell is going to present at 2:30, right? So... in this case, what I was highlighting in my previous video is if you look at the last few recessions. So let's look at when the Fed actually started cutting rates, right? January 2001, the Fed cut here, right? They cut 50 basis points. If we take a look at January 2001, because I get the question all the time, you know, should I sell? When should I sell? You know, when is shit going to hit the fan? If you take a look at this, January 2001, wait, is that right? Yeah, January 2001 was right here, okay? Right here. And then the market fell 44% after that, right? That was after the first cut. If you take a look at the cut that happened in 2007, you know, we had Fed rate hikes to the exact same Fed funds rate that we have today, which is 5.25%. September 2007, the Fed cut 50 basis points because mortgages were defaulting like crazy. Okay, so let's go to September 2007. If we go to September 2007, you'll see here that September 2007 was right at the peak of the market. The Fed cut here. And after September 2007, right, the market dropped by 55%. So in my view, I'm happy that, I mean, you guys that are familiar with this channel know that I was talking about offloading most of my swings, except for select things like Google, Tesla, and only a few things that I'm interested in buying. Bitcoin miners. I'll talk about Bitcoin in a second. But most of the stuff that I bought in 2022, 2023 as a swing, I offloaded towards the end of February, beginning of March, right? And obviously was getting a lot of ridicule, hate, etc. because of that. That comes with the territory. But I make my decisions based on, I make my decisions based on data and not emotion. And I make my decisions for the sole purpose of retaining capital and making money, right? So for me, I was okay with that decision because what is the point of buying if you're not going to take profit? And I thought that was a good time to take profit because of everything that I talked about. So with that said, when the Fed cuts, which right now is looking like end of the year, if at all, when the Fed cuts, that can be your signal that, okay, shit's about to hit the fan. The bond market always gets the clue before the stock market does. And that's when I would start to panic from a recessionary standpoint, right? Recap J. Powell expectations, please. All right, I'm seeing some of these questions. Let's see if this works here. Hard or soft shell tacos? Hard shell tacos are an abomination, dude. So definitely soft shell tacos. But if you have any serious questions about trades or whatever, put it in the Q&A. I'm testing out this Q&A because people, always complain that we get, a ton of questions. Some of them are trolley questions. Some of them aren't really serious questions. I'm not going to answer thoughts questions. Put some effort into your questions. Michael, Sam, Yui. Thoughts on AMD. The reason I don't answer thoughts questions is not because I'm a dick. The reason I don't answer thoughts questions is because thoughts can mean anything. What are your thoughts on AMD chips? What are your thoughts on AMD, the company? What are your thoughts on AMD earnings? What are your thoughts on AMD financials? What are your thoughts on AMD as a day trade? What are your thoughts on AMD calls? What are your thoughts on AMD puts? So that's why I don't answer thoughts questions. They're lazy. They definitely don't convey any real interest in an answer. It's just wanting someone to endlessly talk about something because you don't want to get specific with the question. So are you eyeing a trade for ES today? Okay, this is a good question. So let's talk about ES here, okay? So ES, I actually had a trade earlier on RTY, and I sent this out in the day trades here. We made $250 per contract. This was actually pretty easy money, not gonna lie. Closed it out before lunch. It was a beautiful trade. Then I explained the trade here because I don't just send out alerts. I care more about education than I do about alerts and my thesis for the trade, and that's why we have so many winning traders now that are passing prop firm evaluations and getting funded left and right. But ES, for me, the indices in and of themselves, they're a no-go before FOMC, right? This is what you're going to see during FOMC. This right here is consolidation. You're going to get a couple of manipulation moves, right? So FOMC drops at 2 p.m., you're going to get manipulation that takes out stops on both ends. This is just meant to gather liquidity. Jerome Powell starts talking, you're going to get another round of manipulation, right? You can sometimes play the counter move to that manipulation if we manipulate into a point of interest. But being in a trade before 2 p.m. is suicide because whether you're long or short, your stops are going to get taken out on both ends. So yes, I'm eyeing a trade on both NQ and ES. If you followed my last technical analysis, you would know that I was talking about shorting the S&P once we got back up to this daily fair value gap. And yesterday we had a minus 1.6% day. Today, pretty flat because of FOMC. But as I said before, my target for the S&P 500 is that we eventually revisit the January 2024 highs at around 480-ish on the SPY. And that is my thesis right there for the S&P 500. But yes, I will be looking for a day trade on ES. Guys, there's 1,200 of you here. Hit that thumbs up so that other people find the stream. only 135 likes. You know I'm going to give you a fire-ass trade. Like, you already know that. What I would like to see, honestly, is the S&P 500 come back into this daily volume imbalance that it completely rejected for another optimal short here. Earnings are mostly done. Now, tomorrow we have Apple, which doesn't report guidance. And we also have, who else reports tomorrow? Hold on. I put it in here this morning. I like this Q&A. It really keeps the questions controllable and keeps me on target, because I tend to have ADD with the questions, and I try to answer every single question. But I like this. In terms of earnings, we have Apple. So after today, we have not really anything exciting. Tomorrow we have Apple, and we have that's the last of it, right? That's the last of the Mag 7. Obviously, NVIDIA reports usually 3-4 weeks ahead of all of the rest of the Mag 7. So NVIDIA will be the only one left. But tomorrow we have Apple, and that's going to be a big one. And I might give you guys an Apple play. Last time I gave you guys a play on Tesla, and I gave you a play on, what was the last play that I sent out? Microsoft, right? Yeah, it was a Microsoft Iron Condor. We banked an easy 60% on this. So I'm going to be looking at Apple later on the stream. So if you're interested in that, you definitely want to stick around. All right. Let me see some other questions here. Good question here. Next question, how do you trade options in these instances when it could go either way? Vikram asks, the easy answer is you don't, Vikram. If you like your money, you won't day trade options at all. And two, you definitely don't day trade options during FOMC. Now, the reason I'm not a fan of day trading options, even though I know a couple of traders that only day trade options, but trust me when I say these traders are the freaking 1%, okay? And they understand risk management more than most people. But most traders I know who are day traders that are profitable are either futures or Forex traders. And the reason is because of preciseness, right? Like if I'm in SPY calls, for instance, right? Let's just say that I enter SPY calls here, and I'm hoping that, you know, we get to this arbitrary level here. Let's just say that I'm targeting this recent high, okay? If I jump in SPY calls here, and let's say that SPY doesn't go my way, and we start tanking this way, how much are you down? You have zero idea. You have no idea. If SPY gets to my target, how much are you up? You don't know. You have zero idea. This is why I really hate options for day trading. It's so imprecise that I, as someone who likes accuracy and likes to track my stats, know exactly how much I'm going to lose if I take an L on the trade, how much I'm going to gain, where I could take profit from. Trading options to me is a no-go, and you have no excuse anymore for not trading futures. None. Futures are way easier to trade than options. For one, you don't have expiration dates and theta decay and IV and delta. You don't have any of that shit, right? You don't have zero DTE versus end of the week versus end of the month. You're just trading the most active contract. Second, if you live in the US, there's a huge tax benefit to trading futures. And third, you have prop firms now, so you don't even need money to trade futures. You could just pay $40 for an evaluation, $30-40 for an evaluation. If you pass it, then you're funded. Congratulations. So I personally hate day trading options. Now, you see that I still trade options because I like to use the different tools that I know about in crafty ways. So to set up an Iron Condor on Microsoft, for instance, right? To set up this Iron Condor where I'm betting that Microsoft will stay within a range. You cannot do this with anything other than options. And options are great tools for taking advantage of IV arbitrage, right? If Microsoft misses the expected move most of the time, I can play an IV. I can play an Iron Condor, especially if it pays me, 50% of the premiums for a move where I'm going to win 70% of the time. That's an asymmetrical bet using IV arbitrage, right? But just buying calls and puts and trying to bank on the day, to me, that's a sucker's game, man. And people think it's easier. It isn't. Trading options is a lot harder than trading futures. What trading platform would you recommend for someone in the UK? All right. If you are wanting to trade futures and you don't have a ton of experience or a ton of capital, I would recommend you go with Top Step or Apex for a funded account. Okay. If you have money, I'd recommend that you go with Tradeovate for a futures broker. If you're talking about options, it would be Interactive Brokers. So Tradeovate for futures only because it has very low margins. So Tradeovate for futures only if you're using your own money. Interactive Brokers if you're wanting to trade options as well. And if you're wanting to go the funded route, Top Step or Apex. Is it at some point the market will become less Fed dependent? No. All right. You're welcome, Carol. You're very welcome. Do you plan to trade this live? No. I plan to perform stand-up comedy. Yes, dude. What are your thoughts on gold price? Will it go up to previous highs in the short term? Interesting for me, what happens with gold is going to be dependent on, obviously, the dollar. And what happens with the dollar is dependent on Japan. I'm working on a video right now explaining the situation in Japan. But very, very concerning that we got news that the Treasury is now going to do buybacks as if they're fucking Microsoft or Google. They're going to do buybacks of treasuries. They are panicking here. The last time we did this was in the year 2000, right before the biggest recession that we've had since the Great Depression. And the reason they're doing this is because Japan's currency is dying. And Japan is the largest purchaser of U.S. treasuries, the largest holder and largest purchaser. Japan cannot continue to pour into U.S. treasuries because its currency is going to fucking go even more in the toilet. So the Treasury, the U.S. Treasury, is shaking in its boots because if Japan stops buying treasuries and or sells off treasuries, that is going to spike yields, right? Bond yields are going to spike, and we are going to free fall into a recession faster than you can spell that word. So with that said, what happens with Japan? If Japan is able to bring their currency up and the dollar then, drops in the short term because the dollar's been rallying like a monster since December, then I think gold will have a chance to rally. But until Japan fixes its currency issues, if the yen keeps tanking and the dollar keeps rallying, then I think gold will drop until that stops. So hopefully that answers your question. Now, I was waiting for this level here. I sent this out in the Discord too. to take a short. It did creep into that fair value gap, but it did not dig deep into there. Obviously, it didn't give us a convenient short there. But I am, like I said before, the dollar has broken structure on the high time frame, and you cannot be gold has broken structure in the high time frame, and I think it is due for a massive correction, especially if the dollar keeps on rallying because of what's going on in Japan. Juan, appreciate your donation, man. Thank you so much. Christy, what's going on? Eric Benitez, Huang Lee. I went to school with someone named Huang Lee. No lie. That may not be impressive to you because it may be a very common name where you're from. Armando Coutinho, what's going on? As if they are Microsoft or Google. Yeah, exactly. What you're calling what the Fed will do today? Obvious skip. But the Treasury is now doing what the Treasury is now going to do what the Fed isn't, right? So the Fed is trying to, where's the Fed balance sheet here? Hold on. Let me pull it up for you. So the Fed is trying to roll assets off the balance sheet. To their credit, they did. And like I said in my video, I suspect that they will get back to quantitative easing in no time. But now they have offloaded that responsibility or that honor onto the Treasury. So instead of the Fed buying treasuries, the Treasury is going to buy treasuries. Frank Troiano, what's going on, bro? Can you give your thoughts on INTC? Yes. A lot of thoughts and a lot of prayers. 1.7K watching, only 8 likes. There's 400 likes. I think there's a bug in we still need more likes so that more people find this. But I think there's a bug in YouTube. Do you like Palantir 22? No. I think you are better off waiting for the potential of this gap filling. I mean, I personally had a huge short on Palantir at 23 and change, and I closed it when it dipped below 21. But this gap might not be resolved yet. Is NinjaTrader great for futures trading? Yes, but NinjaTrader is not a brokerage. It's a platform that connects to brokerages. So I have NinjaTrader running on a Windows machine. And this is how I copy trades. And you can see my trades for the day posted on the executions on RTY here, right? This was a trade that I took before lunch. But yeah, I'm running a Windows machine on my Mac, a Windows virtual machine on my Mac that has NinjaTrader that's connected to all of my prop accounts. And I'm going to be doing a tutorial on that soon. But the awesome thing is that allows you to copy all of your trades over. So today I made 400 and change on that RTY short, but copied among 5 accounts. You're talking about $2,000. Now, granted, these right here are fresh evaluations. So I'm still on the road to pass these 5 evaluations. I'm a few $100s away, but then once I do, all these turn into funded accounts. But I will be doing a tutorial on how to do this because I don't actually see many people do it on Mac either. And I am using Replicanto TradeBot. So it is it's not intuitive to set this up, I'll be honest. So I am going to do a full tutorial on that. Do you mostly trade shares or options? Day trade? Neither. I trade futures. Swing? Shares and options. Speaking of gold, Here's what we're looking at, right? So if the Fed maintains a hawkish stance, likely rates will go up. If rates go up, Dixie, which is the dollar, will go up. If the dollar goes up, then I think gold drops some more. So I'll be looking at all these things once we get. Oh wow, we have the decision coming up in 4 minutes. Since you have the capital, what is the reason you choose funded route as well? Because I cannot teach people if I don't go through it myself. So I have my funded accounts here, and I have my real money Thinkorswim account next to it as well. Plus, I'm able to pass the evaluations really easily. I haven't failed an evaluation yet, thank God. So it's extra leverage for me. If I take, a trade in my personal account, and then I could take a trade in the prop firms that cost me little to nothing, and I copy them across, a $500 trade, can turn into whatever it is in my personal account, depending on how many contracts I take. And then a $500 trade in the prop firms can turn into $2,500. So it's just leverage. Yes, I trade directly. I can trade directly on TradingView. Watch, if I wanted to, let's say I wanted to short gold from here. I'm connected right now, so I can trade directly on TradingView. Guys, we also have a prop firm, a whole chat dedicated to prop firms, right? Like I said, we have hundreds of students now passing evaluations, getting funded, etc. So make sure that you join us. Use that coupon code that's at the top of the chat there. If you want to learn how to do this. It's a game changer, honestly. Lying title for bait? The fuck is this idiot talking about? This is how stupid some people are, bro. The title of this, unless I'm reading this wrong, the title of my video is Day Trading FOMC Live. Jay Powell's Big Decision. 2024 Rate Cuts. Unless you thought you were signing up to a fucking cooking show, how is that a lying title? You are also subscribed to this channel. What did you think this channel was about? Don't make me pull up your YouTube channel, bro. Come on. I'll do opposition research right on live. Damn. He doesn't have any content. He's lucky. He was spared. And I know it's a he, because only males act like this. All right. Let's see what CNBC says.
For the decision.
The Federal Reserve leaving rates on hold in the range of 5.25% to 5.5%. It does note a lack of further progress on inflation in recent months. The prior statement had noted that there had been progress. It says the risks to achieving the dual mandate have moved towards better balance in the past year. Note that they had said before we're moving, so that's another kind of reference to stalled progress on inflation. It repeats that it does not expect a cut until it is confident inflation is moving towards that 2% target. It reduced the quantitative tightening runoff to $25 billion from $60 billion. Pretty aggressive reduction there, and that begins in June. A way to think about this is, if my numbers are right, it's a runoff. It had been going at $720 billion a year of treasuries, by the way, down to $300. It left the runoff of mortgage-backed securities the same at $35 billion. Again, that QT goes from 60 to 25 on treasuries and begins in June. That is a cap on the reduction. On the economy, the Federal Reserve says, continues to say the economy is increasing at a solid pace. It says job gains have remained strong, repeats that inflation has eased, but again noted that progress has stalled. And I'm going to repeat some statements that they repeated this time around, but maybe now they're perhaps more important. They said the committee strongly is committed to bringing inflation to 2%. They're highly attentive to the inflation risk, and they're prepared to adjust policy as appropriate if risks emerge. Those have been in the state.
What the hell?
For a long time, and maybe now they're a little bit more important. Tyler, back to you.
I'll give you a few minutes to dig a little deeper into those words and think about the effect of them. Let me come back to you, Jim, and we're going to get back to our panel for some reaction. We're also going to welcome in Rick Santelli and Bob Pisani. Why don't I just go to you, Rick, and get your quick thoughts?
You know, there's been some volatility in the 2-year, the 5-year, the 10-year, the 30-year, and the dollar index. But net out of the volatility, we saw up yield, down yield, but we're virtually at the same spot as before. Steve.
Their website is crashing, guys. CNBC's website is crashing. That's not my fault. That's CNBC.
Read the statement, we're starting to drift a little lower, and I think that speaks volumes. Interest rates have come down from some of the peak levels earlier today, but they're up on the year, very close to some of the highs. And if you go back to the last meeting in March, we're significantly higher than we were then. I think that the salient feature here is simple. We have a stagflationary environment. Growth isn't bad, okay, but it is definitely moving a bit lower. The glide path seems to be lower, and we know that there's not only sticky inflation, there's pockets of inflation that are going up. Even though we seem to read that so quickly, nobody could hardly hear. But I go back to the same old song and dance, okay? My song and dance is easy. If you look at the last 2-year, 69 billion record size, last 5 years, 70 billion record size, the first primary auction of 10s in February at 42 billion record size. We have $818 billion now to service the debt, on its way to $1 trillion, and we're at $34 trillion in debt in the U.S. We're $312 trillion debt in the globe. To me, the big feature here is sticky inflation is going to meet rising debt levels, and it's going to leave the government very little wherewithal to jockey around discretionary spending. And this all comes at a time where I know we're cutting back down to $25 billion on runoff, and also, like in Poltergeist, they're back. Buybacks are back. That was part of the Treasury announcement today. So we have QT ramping down, buybacks moving up, even though we're not easing. It's been voiced as a liquidity issue. I'm not sure. Liquidity issue really seems to be synonymous lately with rates going up quickly, but maybe they're going up quickly because spending's going up quickly.
All right, Rick, thanks very much. We'll come back to those thoughts in just a minute. Bob Pisani, let me turn to you with the equity market reaction.
Very small. S&P was down 11. Now it's only down 5. The key sentence here is in recent months, there's been a lack of further progress toward the committee's 2% inflation objective. There's the higher for longer. And the issue is, are rates sufficiently restrictive to keep bringing down inflation? That's what we're not sure of. The bond market seems to think that there might be higher rates coming. The stock market, I can tell you, is very afraid of that. Remember what happened last year when the 10-year moved towards 5% in October? The stock market fell apart. We're at 4.6. heading towards 4.7. If we go to 5, I can tell you the stock market is not positioned for a 5% 10-year yield right now. So that's a great fear. To the extent that they did not put hikes on the table or clearly indicate that, that's a positive read right now. Broader term, the debate down here is the biggest threat to stocks the fact that disinflation is not occurring fast enough, Or is there a slowdown in growth? People are a little spooked by these earnings reports from McDonald's, Starbucks about a slowing consumer. My own sense is the low-end consumer is having a hard time. The higher-end consumer is not at all. So right now, I'd be much more concerned about the inflation outlook than I would be any slowing with the consumer. Guys?
So, Kristen, Rick, let's slip the word. I know it was intentional, but very intentional. A word that has been in my head for some weeks now, and that is stagflation. Is that where we are right now?
I think it's too soon. I think we have to go back to looking at the second half of 2023 and the data that we had. So when we see the third quarter and the fourth quarter, we had really strong GDP. We also saw disinflationary forces that were really, really strong.
All right, so some big announcements there. Not so much in the fact that the Fed skipped. Like I said, that's not big news at all. But they finally said that they're going to, as I told you guys on this channel, the Fed is going to roll back their quantitative tightening. Now, what is quantitative tightening? In short, the Fed was buying up tons of assets in the form of treasuries and bonds, right? And keeping them on their balance sheet because they were exchanging it for printed cash. So that's how extra cash was making it into the system, right? And after the pandemic, we printed almost $5 trillion of new cash, and the Fed added $5 trillion to the balance sheet. Now they are slowly running that off, but because inflation is wreaking havoc on yields, and yields are going the exact opposite way. The 10-year at one point was down to like 3.7, now crawling back up to 5. That is really scaring not only the Fed, but the Treasury, the government, etc. So they just announced right now that they are going to cut back on quantitative tightening, meaning the amount of assets that they were rolling off, I think it was like 95 billion a month. They are now cutting that back, and they're going to do less. So in conjunction with the Treasury now buying back treasuries, they are obviously very scared of rates, and they're trying to control rates. So that is a big announcement. And that is why you see rates initially on that announcement. If you take a look at the 10-year, the 10-year, this red candle here, initially tanked because if the Fed said that they are going to not let go of so many treasuries, right, not roll off so many treasuries, that is going to put less pressure on yields. And that's why we saw an initial drop. But let's see how long that lasts for. Obviously, like I said, we're going to get a couple of bouts of manipulation here. You could see the first one on the S&P 500, right? This big manipulation spike here. And then we will get another manipulation move when Jerome Powell starts talking. But right now, the S&P is still flat. NASDAQ is down about 0.4%. RTY is green. And there might be a good opportunity in RTY later because on the higher time frame, it still looks bearish to me on the 4-hour and above. So we'll see about that. And then Dow Jones, there might be a decent short on the Dow Jones, which I'm going to look at after Jerome starts talking. But yeah, that is the initial report of the Fed decision there. Let me see if I have any questions. Hold on. What are the key indicators which could help make decision easier for reversal or trend? Easy. Liquidity. It's just all about liquidity. You are trying to, the one question that you're trying to answer is, I wonder if we get a bounce from here. If not, we might get a bounce from here. But the number one question that you're trying to answer is, where is price coming from and where is it going to, right? That's it. That's what you're trying to answer. So if you can figure out your drawn liquidity, then you can figure out whether, and you couple that with your reading of market structure, right? Then you can with a high degree of certainty, predict whether price is going to reverse or continue trend. But I'll tell you this as a rule of thumb, more money is lost trying to predict a reversal than playing the trend. And you are more likely better off trading the trend. Everybody is saying big volatility, but exactly opposite. You know what? I'm just going to read questions that come in through the Q&A. What time does Powell speak? Powell actually passed away. I don't know if you heard. He passed away like 15 minutes ago. Powell speaks at 2:30. I love how this isn't counted as volatility here. I wonder if we get a bounce here. I'm personally going to wait until 2:30, but I think there's a couple of scalps that we can play here. Do you trade Forex? No. Sell in May and go away? Bro, I sold last month. Also, I have no idea who you are or what your portfolio is. Thoughts on coin? A lot of thoughts. A little prayers, a few prayers, but a lot of thoughts. You can sell cover calls. I have no idea who you are or what your portfolio looks like. You definitely don't want to sell cover calls above your cost basis. So I sold cover calls on Monday, but you can sell cover calls now. I don't know what your cost basis is. All right. Bet your favorite books on trading for a beginner. You're not going to learn how to trade from books. Sorry to burst your bubble. You will absolutely not learn how to trade from reading books. You might learn some methods on psychology, right? So like if you read Mental Game of Trading, there's some exercises in there for what you should do in the case of a loss, how to minimize revenge trading. So that stuff might be helpful. You are not going to learn how to trade from a book, I'm sorry to say. The only way to trade is to actually get a TradingView account and either paper trade or trade with a small amount of money. But the only way you're going to learn how to trade is by executing trades. And that's it, not with books. So sorry to burst your bubble there for those of you that like to learn things from books. But Mental Game of Trading is good. The Best Loser Wins is a good book. But again, these things are meant to just adjust your mind frame to how to accept losses, how to minimize revenge trading. They're not going to teach you strategy. which is something that can only be learned from actual executions. Until Powell talks, I do want to check on something real quick. I want to check on what is I want to check on what is Apple's implied move. Okay, this is interesting here. The options market overestimated Apple's move 67% of the time. So tomorrow we have a 3.9% predicted move for Apple, which is the most since May of 2023. Now, one thing, it really depends on how much we get for an iron condor. So just because most of the time the expected move is overestimated doesn't mean you automatically play an iron condor. You have to get paid more than what it's actually worth, right? So I'm going to take a look at iron condor pricing for Apple and see if we can find a couple of plays here until Jerome Powell grabs the mic at 2:30. Is SIP good in Tesla? What is that? What's SIP? So for a let's see this. For a 25 Delta Iron Condor, let's do 165, maybe 160. And then on this side, we'll do 180, 185. $1.67. Yeah, not good enough. But we'll get near $2. So 177.5, 182.5 calls, 165, 160 puts is paying $2 out of 5. I might think about this. But we have time because Apple earnings are tomorrow. I'm going to think about this for tomorrow. And I'll send, if I take it, I'll send it out in the Discord. What is sip? He drinks water. I didn't time that. Damn, we did get a bounce off there. For a little scalp. This is so ugly right here. I need better defined levels. I think on the 5-minute, I think we come down here when Powell starts talking. Are you buying PayPal? I bought PayPal like last year at some point. So no, I'm not buying more. We have Jerome Powell talking in 9 minutes. Okay, so this question is, what time frame would you focus on when trying to grow your account? That's kind of, I appreciate the question, but that's kind of an arbitrary question. Growing your account is not congruent with time frame. A time frame is not going to make you grow your account. Understanding what's going on during the day is going to make you grow your account. And the only understanding you need is liquidity and market structure. That's it. Time frame is arbitrary because you are going to use the higher time frames to establish your bias, right? You're going to use the higher time frames to establish your bias, and then you're going to make your entries off of the lower time frames. But there isn't a magic time frame that's going to make you grow your account. If you don't know how to trade, you don't know how to trade on any time frame. So it has nothing to do with time frame, my man. But you do have to learn how to use time frames to formulate your story on liquidity. So, you know, looking at the high time frames, establishing whether you're bearish or bullish for the day, then looking at a lower time frame, seeing if there is a potential entry. In this case, let's just say off the 15-minute. If the 15-minute looks like a barcode and it's not giving you enough information, you might have to break apart those candles into even more candles, and you do that by going down a time frame. So there isn't a time frame that's like, wow, this is the magical one and you are going to be profitable if you use this. No, you're not going to be profitable on any time frame if you don't know how to trade and you don't know what you're looking for. So I hope that answers your question. When it comes to the Bitcoin miners, what are the correlations tomorrow? I don't know. What are the correlations tomorrow? I don't care about Riot's correlation tomorrow. I care about what are the correlations to Bitcoin. And I already posted this on my Twitter. If you look at my Twitter, by the way, follow me for free trading, daily trading and finance content. But if you look at my Twitter, I posted this on March 18th saying where I think Bitcoin is going to go. It was 67,446 then. And I said that I'm expecting it to go into this box here, right? And if you look at today's price, it's in that box. So we're now at 57. I don't know what the updated pricing is actually. Let me look. Yeah, 57,000 still. So we are in that box, right? Now I'm looking at what miners were decoupled with Bitcoin because, as I was saying before, that when these miners get decoupled with Bitcoin, if you pull up the correlation coefficient, and you type in Bitcoin, I was looking for the complete decoupling of Riot and Bitcoin and an oversold signal, right? So I don't care what Riot's correlation is tomorrow, but if you want to do this for tomorrow, you can too, and see that it's in the same spot as Riot. I would say that take a look at these financials of each one. The least decoupled one is CLSK. But I was looking for an asymmetrical bet like I always look for, and that's why I wanted to find the one that was decoupled with Bitcoin, because you see in history when the decorrelation occurs with an oversold Riot, that's when we tend to get these violent moves. So take a look at the financials of Riot and Mara and make your decision, but that's essentially what I'm looking for. What CNBC's site is so slow, man. Their shit's crashing today. I don't know if it's the same for you guys. I wonder if they're playing this off YouTube. Did you guys know? Aha. Okay, we'll watch it on YouTube instead. Fuck CNBC site. When it starts, we'll watch it on here. Would you ever do a scalping live once a week on Discord? What do you mean? I go live all the time on Discord. Do you not know that? I go live almost every day. Federal Reserve is the YouTube channel name. Well, CNBC's playing it too on YouTube. You prefer Riot to Mar and CLSK? Yes, but like I said, do your own research on the financials of the company. They are playing it on YouTube. Dude, this is YouTube. No, I don't do Forex. Rad R comes in here once a week to say, dude is mean. Rad R, how was I ever mean to you? Anonymous donated $20 to St. Jude. Thank you so much, whoever that was. Appreciate you. Rad R, since you want to be such a crybaby on every stream, how was I ever mean to you? Well, I guess I just called you a crybaby, so. What's the ticker for correlation coefficient? If you go to TradingView and you go to indicators, Sultan, appreciate you, man. Thank you so much for donating St. Jude's, man. Appreciate you. Guys, it's called entertainment. All right? People take shots at me all day. It's fine. Correlation coefficient. This is the one you want. Right there. And then you type in the symbol that you want to run the correlation with. In this case, I did Bitcoin. And you hit apply, and then you get it. So you could do this between like the dollar and gold, or rates and the dollar. You know what I mean? Guess who's Bazak? Back on the block with the hose. Face my Mac. Make me relax. Damn, so many meanie comments. All right, let's see. J Powell on the mic. Sultan, what were you trading today? Did you take that RTY trade from earlier? Shout out to Sultan, man. Pokamania donated £5 to St. Jude's. Appreciate you, the Pokamania or Pokamanja. I don't know. I assume that's something way ahead of my time. I inherited 100K. What would you invest in? Have you ever been to Vegas, Christopher Naresh? Christopher Naresh inherited 100K and he wants to invest it. Do you guys think he should invest it or have the best weekend of his life in Vegas? I'm thinking best weekend of your life, bro.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power. especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular. But it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also we look at surveys of workers and, surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that, that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored?
Or anchored.
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
You know, I don't want to get into complicated hypotheticals, but I would say that, you know, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Thanks for taking our questions, Chair Powell. I wonder, you know, obviously Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. You know, our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask what would it take? You know, I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too. Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations. It could be a combination of things. But if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So on, let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%, and another path could be, you know, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, you know, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. I mean, is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And For sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably, that's what, or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we've said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months' data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking.
And Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view. I think that, in fact, we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened, and I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates, and this is a plan we've long had in place to slow, really not in order to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig Torres from Bloomberg. 2 questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree. It's, nobody likes it. But is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it would be appropriate to cut until we were more confident that inflation was moving sustainably at 2%. Our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them is further away from goal than the other, then you focus on that one. It's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation, and this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it, and that's how we think about that.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It would be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your question, your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output, but you've also got more supply, But those people also come in, they work, they have jobs, they spend. So you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive, and our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years, and that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria. Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. if we start down that road, I don't know how you stop. So.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that thing.
Guys, I'm scalping the shit out of these moves.
One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially today. But they are
across
not
5
down
accounts,
to where they
1,
were
2, 3,
before
4,
the
5.
pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
By the way, I think if we look at the 4-hour, this is what I was going off of, right? So if we look at the 4-hour, I think the manipulation move is exhausted here. So this to me is the manipulation move. So I was scalping basically the bounces off of this manipulation move. So this is on the 4-hour. NQ looks weaker than ES for sure. And so based on the lower time frames, what I'm doing is scalping these moves off of the lower time frames, these moves short, off of the lower time frames based on the high time frame liquidity zone.
Up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes. I mean, I think that restrictive monetary policy is doing what it's supposed to do, but it's also, in this case, unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And so this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. We have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are there are a number of places in the economy where where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So that you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. They have their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago, and that's.
Someone asked, is it the top for today? Yeah, I think it is. I don't know how much longer he has to speak, but I think that is the extent of the manipulation move. Do I think that there's going to be a crash thereafter? No. I mean, I don't know, honestly. I think that there will be a reversion back down from this manipulation here. So if you look at the manipulation move, like if you look at the 4 hour, this is just the 2 p.m. candle, right? This is the candle since Powell started talking. So like I said, we're going to get a manipulation move, and we manipulated into this 4 hour gap here. So that is why I think that we saw a top or near top, but it doesn't mean that we're going to crash epically. I guess it depends on what he says. We do tend to see a reversion back down. Are we going to go all the way back down to where we started? Maybe not, but I think that we come back down to at least retest like some of these, inverted gaps here. Once he's done talking. But yeah, I do think that the extent of the manipulation has taken place. And you could see this consolidation here. If we don't break to the upside, it is going to be hard to break to the upside, in my opinion, because we don't have much up here. But if we don't break to the upside, then I think this consolidation leads to a burst back down. Like I said, it doesn't mean that we turn negative. I think that likelihood is we end positive on the day still, green on the day still. But we do have some imbalances down here in order to revert to, if that makes sense. Nobody can predict the future. Why are you watching a trading channel, bro? I don't know. All I know is that we crushed it in 5 accounts here. Thank God for the trade copier. That's all I'm going to say. It's not about predicting the future. It's about a probability game based on your analysis. You called it a manipulation move last FOMC, but ES kept going up the next few days. And then what happened? Manish. And then what happened, bro? And then what happened? Tell me. Okay, it went up next few days, and then what happened? What happened to the market then after the last FOMC? Stock Mosa, buy the dip on Neo. How many fucking dips is that guy gonna buy on Neo? Yeah, Manish is sitting here trying to troll me. And I just made 1,200 on 5 accounts. For real on Neo? I don't know, bro. Good job if that's what you wanna trade. What do you think to invest with Henry? Do I think you should invest with someone named Henry? I don't know where you guys come up with these questions, man.
Of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent. We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have...
All right. So initially, honestly, like, I'll be honest, I wasn't listening to every word he said. It just sounded like regurgitated stuff. I was just scalping the shit out of these moves. And it's been awesome. But I'm not surprised that they're cutting back the extent of their balance sheet reduction. I already predicted that that's probably what they were going to do. NQ looks a little weaker than ES. ES dug a lot higher into its imbalances. NQ still hasn't taken them out. If you are going to short one, I would pick NQ, but if you don't know how to scalp, this is not a playground you should play in. If you're trading options, good luck. You threw away all your money. If you're trying to trade up here, if you caught calls on the way up for some reason and it fit your thesis, then congrats. But trying to trade up here with options is a no-go zone. Whereas with futures, you can still make a lot of money in these types of ranges. I do think that is the extent That would have been nice. The fuck? Like I said, I think this is the extent of the move for today. I'm not expecting to turn like severely red or anything. Anything is possible, but I do think that that is the exhausted manipulation move that I was talking about earlier. Oh, he just walked out. Okay. Well, this makes sense now. Why that happened. I wonder if we take out these lows here. Let's see if it gives us a retracement up here. I hope we can retrace back up here. All right, we're up on the day quite a bit, so I'm going to try another scalp from here. Off of this 3 minute. But I think the goal is to get down to this imbalance right here. Like I said, I'm up quite a bit, 1,200 across 5 accounts. So I'm taking this one contract scalp here to see if I can get down to that imbalance. And if not, then I'm not going to give back any money on the day. Let me just poke around and see if I miss something here, just in case. I'm not gonna move my stop yet, even though it's up to 275. Nice. It's up 300, 330, 480, 560. All right, I'm gonna close at 525. Easy $500 there. Another $500 added to the tally. Beautiful scalp. I think we could get a slight bounce here, which would have given up my gain. So I don't want to give up $500 and something, but my target is this box right here. Don't get greedy. All right, bro. I'm not getting greedy. I'm just exploiting what I see in front of me. I think we get to that box right there. It's funny, like you can't satisfy everybody, right? It's like, when are you gonna live trade? Okay, bro, I'm gonna live trade. Give me a second. Wait till Powell stops talking. I start live trading. Don't get greedy. Shut the fuck up. I'm just messing with you guys. What do you think the market will look like tomorrow? Juan Pablo, ask me tomorrow, bro. Ask me tomorrow. Man, we continue to kill it on the live trades, bro. What the fuck is that box? It's a magic box that your Uncle Z drew. That's what that box is. Guys, we do this every single day. Come join us. Be part of the crew. I trade live with the crew every day. What'd I tell you, bro? Draw the boxes. All right? You draw the boxes. That's where price is going to go. Just blew my account because you're doing exactly the opposite of what I was doing, bro. That's why. Apple reports tomorrow. Wow. There it goes in the box where it belongs. Thank you. Made 500 with that trade. Awesome. How are you copying accounts in TradingView? Because I'm connected using NinjaTrader. Do you make like 6K today? Around there, yeah. More with that last trade. Oh man, I should have held that fucking trade. I told you we were going in this box. I should have held that trade. Oh well. Banked 800. Made 200. Made 100. Amazing. I just got blown. How are you fools blowing the accounts? All for show said exactly. Are you serious? What do you mean exactly? How did you blow the account? I told you that I'm taking this short. So what? Did you buy calls? What did you do? Made 700 on that short. Made 500 on that short. I think they bought instead of selling. Oh, you might be right. Banked 600. Made 130. Made 1K. Jeebus Christ. Making everybody rich today. Somebody sent me lunch. Made 600. Serrano donated $20. St. Jude's. Appreciate you. He literally showed his trade live. I know. Surf. Tell him, bro. Tell him. Made 1.8K times 2. 800 long, 440 short. Made 1.1K. Oh, my God, bro. Yeah, you guys better hit that like, man. Only 747 likes, and it sounds like I fucking created an empire of rich people today. $2.2K. Han Solo, thank you for your donation, man. St. Jude's, $5. Thank you so much. Have you ever been wrong? Never known it. Of course I've been wrong, bro. It's just, I just take high probability trades. Henry Nguyen. Oh, wait, is this the Henry that you wanted to invest with? Whoever asked me about that? Would I invest with a guy named Henry? Were you talking about Henry Nguyen? Henry Nguyen, thank you for your donation, bro. So many wins, but more importantly, so many donations. Top Step in Apex, Obina. 25K, says Kathy Rent. That's wild. Kathy, you made 25K? Shane, I held all the way, made 1,700. Hell yeah. Guys, do you know how crazy it would be if I live streamed every day on YouTube? Lucky for you, I live stream every day. Not on YouTube, but on Discord. So come join the gang if you want to get some of this. I guarantee you nobody can reprice like we do. Surf, appreciate you, man. Donated $20 to St. Jude's. Made 340, says Mark Garlington. Ryan Solve donated $5 Canadian to St. Jude's. Thank you so much. Made 250, says Lakegos. Thank you, Oscar, for that. What if NQ flipped red? What if NQ flipped red? Okay, so what? What if we actually made money today? Where can I get a bot that copies and pastes your trades? Bro, if there was such a thing, you know how much I would charge for that thing? I would charge $100,000 for that thing. Because you would get your money back before the end of the year. All right. So, with that said, let's see if we can catch a continuation here. I am going to get greedy because I'm up a fuck ton today. So let's see, boys and girls, if we can capture a continuation here. I expect to see a little bounce off here. Now, will this bounce give us an entry or not? Bro, that's the thing. It's like, thank God we caught a part of this move, but once it dies, man, it dies. Pump and dump. I told you it was manipulation. Someone said, is that the top? Schwartz says, bro, so cocky. Guys, defend me against this asshole. You see how many people made money today? Schwarzkopf, how many people made money today? It's all in good fun. 1,300, says Todd Mullis. Terry says 780 across 10 accounts. Holy hell. Shane, appreciate you, buddy, man. Thank you so much for your donation. Fernando Partida donated $5. Thank you, Fernando. Appreciate you, brother. All for show says I'm going to blow another account. What, are you going long, all for show? What the hell are you doing, bro? Mark Garlington, thank you, bro. Appreciate your donation, man. $20 to St. Jude's. Maher Ben Mansour, $500. Fire, bro. 1,000 euros for Scene Catcher. This might be the most money that I've ever seen an entire group make. Usually it's like a few people who know what's up will take trades with me. But it seems like every single person shorted the market. It's not easy to try live in front of hundreds of people. Appreciate you. And let's call it thousands of people. Grateful for that. Invest with Henry is a YouTube channel, and he trades a 2 million account. You should pull him up and peep it. Bro, I know him personally, man. I'm just messing with you. AA says, because of you, I can upgrade my wardrobe. I mean, hopefully you're wearing clothes right now. And, you know, you're just swapping them out for something you like. Would you go long here next week? I don't know. Another 600 says Karen Brody. Dope. Halal trades. That's fire, bro. But is there such a thing as a halal trade? Honest question. Is it halal to trade futures? I have no idea. But I like that name. 2.2K on the day for halal trades. 10K for the week, says Mattia Zagon. I was long this morning. You may be confident to get out at the top. Hell yeah. Lahiru Swandarwan says 900K. 900K what, bro? Rupees? Bro, if you made 900K dollars, I'm going to come find you. Lahiru Swandarwan said he made 900K. Boy, you better be talking about rupees. What is 900K? $900K. That is still respectable, yo. 900K rupees, $2 is still $10,700. Bro, Lahiru Swandarwan. If you still live in India and you're pulling 900K rupees in one day, bro, you are probably living like Shah Rukh Khan. You're living like a fucking king today, bro. You're going to be the celebrity of your neighborhood today. Yes, I go live every day. In the Discord. Yes. Bro. Why is NQ flushing? Because I told you it would flush. Now, I personally didn't think that it would turn red on the day. I said there is a chance, obviously, it could turn red on the day, but I thought that it would give up. I said that this was likely the top and that we would give up a lot of that it would revert to the mean. Now, my initial target was here. That was initially what I drew, right? And now we turn slightly red on the day. But it's because this whole thing's a manipulation. This is one big power of three, right? So for those of you in the mastermind, you already know this. Consolidation, manipulation, right? And now we have the expansion move down. It's just the extent of the expansion move is hard to determine on news days. So conservatively, I was targeting this 1 hour inverted gap, right? But obviously we now are flat-ish on the day. It's like almost zero on NASDAQ and 0.15 on S&P 500. Can you trade futures on the weekends? Only on Sunday. It's 1 a.m. in India. Lahiru should go to sleep. Bro, if Lahiru Swandarwan just pulled 10K and it's 1 a.m., it sounds like that's time to party, bro. It doesn't sound like that's time to go to sleep. Lahiru, don't listen to Nirav Dedia. Nirav's trying to get you to go to sleep, bro. I think you light up the village tonight. Craig Taylor said, I made 1K and it's 245 in Thailand. Deepanjan Chowdhury says, sir, I'm in Bank Nifty put. Bro, listen. Just because I made Lahiru rich doesn't mean that I'm going to be giving Indian stock market tips. All right. He got rich trading the U.S. stock market. I don't know anything about Nifty, so don't ask me. Anonymous donated $5 to St. Jude's. Appreciate you, man. Or woman, whoever that was. Thank you. Oh, T Rob, appreciate you, bro. Thank you, man. Niraj, I'm trading from Maldives and going for a dip in the ocean. Oh, bro, you're going for a dip in the ocean? Hold on. Okay, this is what time it is in the Maldives. And Niraj says he's going for a dip in the ocean. Bro, you know, you're going to see fucking sea monsters that you've never seen in your life. It's pitch black in the ocean right now, bro. I would say wait until tomorrow. Niraj is about to get eaten by a fucking intergalactic shark, dude. He's going to take a dip at 1 a.m. Niraj is about to be eaten alive by a fucking neon-colored blue octopus. Is your real name Zohan? The fuck? Isn't that like a movie? An Adam Sandler movie? You must be my dad's age making that joke, dude. DX Thunder donated $20. Appreciate you, brother. Thank you so much, man. Made 4 cases. Yassas. Yassas. Do you know what that means in Greek? It's 7:45 in New Zealand. Been up the whole night. Well, no, it was worth it. Niraj says, after making 25K, I have to dip in the ocean. All right, bro. Chirag Patel says he's not Indian or Paki. Who, me? I think that's pretty obvious. Chirag Patel. All right. In terms of another trade, I was hoping that we would retrace up here for a continuation back down. That did not happen. And that's okay. We banked nicely in it, and everybody here made money. So, Top Step or Apex, which has quicker payouts. They're both probably the same. They're both really good. Z is from Area 51. Yes, that's close enough. Anonymous donated $5 to St. Jude. Whoever that was, appreciate you. Karen Brody donated $20. Appreciate you, Karen. 350 algo incoming. Yeah, bro, it's incoming, but we don't have an entry. Thank God we caught the one from up here. Do you have a video that explains how to execute for a value gap? No, but there's tons of videos online. I do have a mastermind, which session 4 is tomorrow. Check the link in the description if you want to sign up for it. It's a live mastermind. Anonymous donated $20 Canadian. Appreciate you. Roger Soul, what's going on, bro? You took a GC short? On the strength that rates move up. Yeah, rates bottomed out after Powell started talking. And they're climbing up, which would rally the dollar. Rates didn't bottom out. The dollar bottomed out. So the dollar rallying would cause a drop in GC. You know what? GC, if it wasn't so late in the day, there is a nice trade here too. There's a short here on GC, but there's only 9 minutes left. Up or down? Sorry. Bro, there's 9 minutes left. Starbucks down $15 today. Yes, they reported horrible earnings yesterday. What do you think Apple will do after earnings? Who knows? Looking for that link ASAP. It's the pinned one here, bro. The traveling trader right here. This pinned comment. Click that if you want to join. People think I'm exaggerating, and someone asked if I've taken a loss yet on the live stream. But we live stream every single day on the Discord. I don't live stream every day on YouTube. When do you plan to release the Top Step trade copier video? Sometime this week, either tomorrow or the day after. What time do you start streaming? Usually after news in the morning. So either market open, or if there's news, say like at 10, then I'll start after the news is digested. Are you going to be live on YouTube tomorrow? No. I'm going to be on the Discord tomorrow. All right, guys. Appreciate you. Thank you for rocking with your boy. Fucking seems like hundreds of you made money today. So I'm happy for that. I'm happy you guys joined. I'm happy you made money. If you want to join us every day, click the link. Join us in the Discord, and I will see you guys there for the rest of the week. Mastermind session 3 is going to be tomorrow after market close. So we're going to be going over order blocks, fair value gaps, inverted fair value gaps, etc. But appreciate you guys, and I will talk to you on the next one. And hopefully Niraj doesn't get eaten by an enormous whale in the Maldives. All right, guys. Talk to you soon. Peace.